Welcome to this explainer. Today we're breaking down Intuit's massive guidance reset and what it actually means for the stock moving forward. Let's get right into it.
So, to really grasp what's happening here, we've got to map out their ecosystem first. Intuit is an absolute titan in the US financial software space. We're talking roughly 100 million customers globally, and they do this across some major household name platforms. QuickBooks for business accounting and payroll, TurboTax for consumer tax prep, Credit Karma for consumer finance, Mailchimp for marketing, along with ProTax and their newer enterprise suite. Now, this isn't just a random list of independent products. It is a massive, highly interconnected moat. The whole strategic advantage here is locking users into the ecosystem, using their financial data to seamlessly cross-sell multiple services. Once you're in, Intuit makes it incredibly convenient to stay, and honestly, a massive headache to leave.
To understand the recent panic surrounding the stock, we first have to rewind and look at how good things actually were just a moment ago. Taking a look at their fiscal 2026 results, they just closed out a highly impressive fourth quarter. They pulled in a staggering $4.35 billion in revenue, with adjusted earnings per share coming in above expectations. On paper, these are exactly the kind of robust, market-beating numbers that usually send a stock climbing.
And that top-line figure, it represents a very healthy 14% year-over-year growth. For anyone holding the stock, 14% was exactly what you wanted to see. It proved that the company's growth engines had real, tangible momentum heading into the summer. They were showing the market that they aren't just some seasonal tax software company reliant on April filing deadlines anymore, but a year-round financial powerhouse capable of consistent double-digit expansion.
But despite knocking Q4 completely out of the park, the stock tanked over 10% in extended trading. No way, right? Why would that happen? Well, because the underlying investment story fundamentally changed. You see, the market doesn't really care about what you did yesterday. It cares entirely about tomorrow. And the forward-looking narrative for Intuit completely shifted after their earnings call. The momentum investors thought they were buying into suddenly hit a brick wall. The core catalyst for this sudden drop is their fiscal 2027 guidance. Intuit expects revenue of roughly $23.3 to $23.5 billion. Now sure, that is still a huge absolute number, but it represents revenue growth slowing down significantly to just 9 to 10%. Why is a drop from 14% to 10% so terrifying to Wall Street? Well, it forces analysts to completely reprice the company's future cash flows. When you're priced as a premium growth stock, any deceleration signals to the market that your days of easy expansion might be over, instantly triggering a sell-off as institutional money recalibrates the valuation.
But when we dig a little deeper, we find that this growth is incredibly uneven. Taking a snapshot of their Q3 data right before the reset, there's a stark contrast. The online ecosystem is soaring with a 19% growth rate, and global business solutions hit a very strong 15%. Meanwhile, consumer revenue is lagging far behind at just 8%. It paints a picture of a company with vastly different momentum depending on which division you're examining. The enterprise side is carrying the weight, while the consumer side is acting a bit like a parachute.
For long-term investors, the noise around that 10% drop really distracts from what truly matters here: QuickBooks. This is the undisputed crown jewel of Intuit's portfolio. It's the true engine driving the healthiest, most resilient parts of their growth. And it's the ultimate anchor keeping their massive small and mid-sized business client base firmly secured.
The reason QuickBooks is absolutely critical is because of what small and mid-sized businesses increasingly demand: an all-in-one solution. Intuit is brilliantly rolling accounting, payroll, payments, invoicing, cash flow management, business banking, and AI assistance all into one incredibly sticky ecosystem. I mean, think about how painful it is for a small business owner to completely rip out their payroll system, retrain their staff on new software, and migrate years of accounting data to a competitor. It's a total logistical nightmare. Because of that immense switching cost, businesses become deeply reliant on Intuit's platform, making this segment the company's biggest long-term value driver.
Now, while the business-to-business side is anchored by that deep integration of QuickBooks, the consumer side of Intuit operates completely differently. Shifting over to the consumer portfolio, we see a really fascinating contrast between two highly recognizable brands: TurboTax, which acts as this mature, incredibly reliable cash machine, versus Credit Karma, which serves as a highly underrated growth engine. These two divisions serve entirely different strategic purposes in Intuit's current roadmap.
Let's talk about TurboTax first. It is an enormous franchise, bringing in billions and extremely predictable revenue. The problem isn't that TurboTax is weak. The problem is the law of large numbers. Simply put, when practically everyone in America already knows what TurboTax is, finding brand new customers becomes incredibly expensive and difficult. Growing from such a massive base is an uphill battle. For fiscal 2027, TurboTax revenue is expected to grow a very sluggish 2 to 3%. Management is currently prioritizing customer acquisition and keeping market share, which means they're likely sacrificing short-term margins just to keep their dominant position intact.
On the flip side, we have Credit Karma. This platform absolutely surged, growing 15% in Q3 of fiscal 2026 to reach over $630 million, driven heavily by personal loans, auto insurance, and home loans. Credit Karma is basically a giant data engine. It capitalizes on a unique position situated perfectly at the intersection of consumer credit data and financial product recommendations. If Intuit can deeply integrate AI to improve personalization here, predicting exactly what financial product you need before you even search for it, they can dramatically increase monetization per user without even needing to grow the overall user base.
Unfortunately, offsetting that consumer momentum is Mailchimp. This $12 billion acquisition remains a major weak spot and a heavy anchor on the company's overall growth metrics. Looking ahead to fiscal 2027, Mailchimp's revenue is expected to be roughly flat, or potentially even down 1%. The integration has been bumpy, and they're facing fierce competition in the digital marketing space. It's a significant drag that management desperately needs to stabilize if they want to convince Wall Street that the original acquisition wasn't a massive overpayment.
Zooming out from these individual segments, they all lead us to one overarching wildcard that completely defines Intuit's future: artificial intelligence. AI acts as both their greatest opportunity and a potential existential threat. Think of it as the ultimate double-edged sword. On one hand, AI can brilliantly automate bookkeeping, prepare complex taxes in seconds, and drastically reduce customer support costs. On the other hand, the existential threat is very real. If tools like ChatGPT make accounting and tax prep dramatically easier and virtually free for the average person, why would anyone pay a premium for traditional software like TurboTax? The perceived value of their legacy products could absolutely plummet.
To counter this threat, management is aggressively transitioning the company's entire identity. The goal is to move from being just software people use to a proactive AI financial platform that works for them. Because they are heavily investing in this AI-first operating model, there's a direct impact on you as an investor. Management is basically asking for your patience. They're asking you to accept lower profit margins and slower growth today so they can afford to build a massive defensive AI moat to protect their business tomorrow.
Thankfully, they're navigating this massive strategic transition from a position of immense financial strength. Intuit boasts what analysts call a fortress balance sheet. As of early 2026, they're sitting on approximately $3 billion in cash and short-term investments against a very manageable $6.2 billion in debt. Take a second to digest that ratio. It's incredibly healthy for a company of this size. This financial stability gives them the immense flexibility to invest heavily in expensive AI development while simultaneously keeping investors happy by returning capital through active share repurchases and consistent dividend growth.
So the crucial point here isn't whether Intuit will survive or remain profitable. It almost certainly will. The real question is strictly about valuation. Specifically, the stock is currently trading at a trailing price-to-earnings ratio of roughly 22 times earnings. So is that a remarkably cheap valuation for a historically high-quality tech stock? Or is it a value trap? A value trap is a stock that looks cheap on paper, but is actually priced perfectly because the underlying business is in permanent decline. We have to figure out if that 22 multiple is a bargain or a giant warning sign.
Let's break down the math into three potential realities. In our base case scenario, where the company sustains 9 to 11% growth, a multiple of 22 to 27 makes the current stock price look quite attractive. But let's look at the extremes. If business growth slips into the bear scenario of just 5 to 8%, the market will severely punish the stock, compressing that multiple further down to 17 to 21 times earnings, meaning there's significant downside risk. Conversely, look at the bull scenario. If they successfully monetize AI and growth re-accelerates past 12%, we see multiple expansion. That means investors are suddenly willing to pay a much higher premium for every dollar of earnings. In that scenario, this stock becomes an absolute rocket ship.
Whether we hit that optimistic bull scenario or fall into the bear scenario depends entirely on a specific set of catalysts and risks. The bull case is bright, relying heavily on flawless execution of this AI monetization, aggressively scaling the enterprise suite, maintaining Credit Karma's fantastic momentum, and continuing double-digit growth in QuickBooks. However, we have to carefully weigh that against the bear case, which fixates heavily on severe execution risk, the sheer maturity and sluggish growth of TurboTax, the ongoing financial drag of Mailchimp, and that ultimate looming threat of AI entirely disrupting their core software business models. Distilling all of this analysis down into a single investment scorecard, the overarching picture becomes pretty clear.
We are fundamentally looking at a 5-star quality business. They possess an incredible competitive advantage, deep moats, and highly recurring revenue. However, that pristine quality is balanced against a distinctly high AI risk and a much more cautious 3-star near-term outlook. Why? Because massive strategic transitions are inherently messy. Wall Street absolutely hates messiness and uncertainty, and that friction is going to create significant volatility in the near term as they rebuild their core engine.
So let's get to the final verdict. Based on the analysis, Intuit is absolutely not a broken company. It's a fantastic, highly profitable titan, navigating a notoriously difficult transition, shifting from a reliable, premium growth software stock to one that urgently needs to prove its next growth cycle. Because of that, it's considered a near-term hold, while we wait for the dust to settle and the metrics to stabilize, but a compelling long-term buy on any major market weakness. For aggressive investors looking to build a position, a staggered buying strategy, dollar cost averaging into the stock over several months rather than buying all at once, is highly recommended to protect against any further immediate downside.
All of this leaves us with one incredibly critical question to watch moving forward. Will their highly anticipated September 2026 Investor Day reveal the granular, undeniable details of their AI strategy and ultimately prove to the market that this current growth reset is just the launching pad for their next dominant chapter? That is the date every Intuit investor needs circled in red on their calendar. Thank you for joining me for this explainer. Keep your eyes on the data, and we'll see you next time.